I'm Izabella Kaminska, I'm from the Financial Times, and I will be moderating this session on commodities and derivatives regulation, although I think we might hijack the title a little bit and talk about shadow financing in commodities as well. So we're joined by Michael Masters, who is here in his role as founder and chairman of Better Markets, although most of you probably will have become familiar with him from his testimony to in the Senate committee hearings on commodity speculation back in 2008, which was, if you recall, a completely different era in commodity markets than it is today. We're here now talking about literally the doldrums of the bottoms of the commodity prices. Nobody saw this coming. Back then we were ascending in the $100 territory. So it'll be very interesting to see how a bit of hindsight has influenced that debate. And we're also joined by Robert Johnson, who is president at the Institute for New Economic Thinking, and he will be offering his perspective on what's going on as well. So I'm now going to transfer the podium to Michael, who has a brief, a 10-15 minute presentation, and we will then move on to another presentation as well, and then we'll have a little chat.
Good morning, and I'm Mike Masters, and happy to be here up at the Minsky Conference, and always enjoy coming to these conferences. There are different views here, and I think having different views is very helpful, and I'm going to talk about some different views today in commodities. I'm not going to talk about too much regulation because there's really not that much going on in commodity markets regulation in the U.S. anyway. Right now there's a position limits bill out there. It's not a bill, it's a rule making that the CFTC is working on. Timothy Masad, who's the chairman of the CFTC, is sort of going back and forth with the commissioners, and the idea is that we'll have some kind of position limits framework at the end of President Obama's term, but that's not for certain. So that's sort of the only thing that I know of that's really going on in the U.S. In Europe, there's some stuff going on with the MiFID rules, and that's in flux. Again, I'm going to talk more about sort of the after effects of commodities, or the commodity sort of boom bust in this period of time that we had, and some perspectives that I think are important for policymakers and for market participants to consider, because I think some of the narratives that you probably read about or heard are maybe worthy of being challenged. And so I'm here. I also have a day job. I'm a long-short hedge fund manager, and so I'm here under the auspices of Better Markets. And just so you know, Better Markets is a nonprofit, nonpartisan organization. It's there to serve the public interest. I was one of the founders of Better Markets. Dennis Kelleher is our CEO, and we have a staff of about 15 in Washington, D.C. And what we're really trying to do is augur for a financial system that is safer, that's transparent, and that's more resilient. Ourselves and allies like Rob at INET, we're battling really the giants. We're battling the financial industry, and what we're really trying to do though is really argue for the public interest in the halls of Washington, both at Treasury and with regulators and in Congress. So anyway, so just to talk a little bit about some of the beliefs by folks that are expressed, mostly market participants, from the shadow financial system. The shadow financial system obviously is not the regulated financial system. It's hedge funds, private equity sponsors, other kinds of intermediaries than the traditional regulated banking system. What I'm really going to just talk about briefly is just some alternatives to sort of the consensus that I think is the consensus anyway that I hear and read about from people, and then what those investor views mean for other markets, and price formation or other markets. And I think this this is actually sort of the crux of it. I think this is really important, especially as of today. And then something I actually enjoy, and Izabella mentioned that I did talk about commodity market speculation. You know, but something I think that's really interesting about the commodity markets versus traditional financial markets is that they really are at the intersection of the real economy and the financial markets. And especially when you have enough speculation in these markets and you financialize many of these markets. But at the end of the day, they're still real economy markets, and they still have significant effects on the real economy. And that's what I think is so interesting about commodities in general versus just traditional financial markets, which obviously affect the real economy, but in some cases maybe have a less direct effect. And so I'm just going to give a couple of investor views that I think are more or less sort of the consensus view from what I can see anyway. And that's certainly open to discussion, but you know, what I hear a lot still is, you know, when you see the oil market go down or commodities markets go down, people say, oh, well, this must be telling me something about demand. Therefore, I need to be concerned about, you know, future economic demand and vice versa on the other side. Indeed, in the first quarter of 16, we've seen that almost precisely, almost day by day, that correlation. And the problem with that is that price formation is still mostly about flows in commodities. And that's the issue, or certainly one of the issues, is that are prices going down because people are getting out of commodities from a financial sense, from a financial flow standpoint, or vice versa, or commodities going up because of that? And so commodity prices may represent broader economic demand. They may not, and also commodity price formation can have a lot to do with supply as well as demand, especially after you've just spent $1 trillion or so in CapEx and commodities over the last 10 years. You would assume that there would be some benefit to supply from that $1 trillion that was spent. So, at any rate. So even if commodity prices could be counted on as sort of, you know, true arbiters of economic conditions, there's more biases, there's more issues here. And that is because most of the people in the shadow financial system that have financed commodities also have ways of hedging those commodities in the financial markets. In other words, they're typically financial market participants with financial market participant views. And so, therefore, if prices are going down and they financed those commodity projects, they're not happy, because they're basically in the same boat as the producer here. The commodity producer doesn't like lower prices. If I finance the commodity producer, I don't like lower prices. But they don't represent most people out there. In fact, they don't represent consumers at all, because they're not financing consumers, they're financing the producers. And so there's this real bias, in my view, whereby financial market participants from the shadow financial system look at sort of only one side of the ledger, because after all, commodities prices are zero sum. If the price goes down, the producer loses and the consumer wins. And in the media, the financial media especially, we don't hear about the benefits to consumers, and there's no one out there, because that's a diverse lot, that's even considering that idea. And so my own view is that that this financing bias is one of the reasons for that. And so I think we get one side of the story a lot, and it goes further, because throughout this cycle, 10, 15 years ago, we didn't have the kind of financial innovation, the kind of ETFs and the products that we have today that allow people in financial markets to hedge all sorts of different risks that they weren't able to hedge in the past. But there's a cost to that, because if you have a portfolio of commodity projects that you've finance, now you can go and you can use various instruments in the public markets to hedge those, right, by selling those instruments. So if you think about the HYG, which today is about 15% commodities, in the beginning of 14, before oil prices really went down, it was about 20% commodities. But the fact is if you want to hedge your credit exposure, you can use the HYG, and many people do, which means that everybody's credit is going to cost more now because of the activities of the shadow financial system in trying to protect themselves and their own portfolios. And the problem with that is people look at the HYG or other credit indices, and they say, well, there must be something wrong with the economy because I see all this selling and credits going up in yield and down in price, so therefore there's a problem. And it's a bit like a game of telephone. I mean, when the first person gets on, it's one thing. By the time the last person hears the message, it's a much different message. And I think that's what we're seeing here oftentimes, is that we're seeing people finance commodities and then put those hedges out, and there's a cost to that. I mean, the risk goes somewhere. In this case, it goes into this sort of giant dumping ground, whether it's the S&P or the HYG or one of these other indices that people can hedge their exposures. And this isn't necessarily bad or good. This isn't certainly pejorative one way or the other. I just think people need to understand that these prices may have a lot more to do with these activities than really anything else. And they're not necessarily fundamental arbiters, again, of anything in the economy. They're fundamental arbiters of people's need to hedge their own portfolios that may have done things that they shouldn't have done in the last CapEx commodity boom. And again, if this is the case, then everybody's focused on the negative. Everybody looks at all these market-based things. Then, in fact, maybe things aren't as bad because we're looking at things through this risk transferal mechanism into the broader markets. So there's this sort of negative feedback loop, which we end up with, again, courtesy of this shadow financial system, we end up with all sorts of other market impacts, whether it be in currencies or in credit spreads or in equities. I wanted to, but the correlation right now, and I don't have it in front of me, but the correlation right now with regard to equities and oil prices is among the highest it's ever been. It's and the broader direction of the market, and so that really doesn't necessarily make a lot of sense, because oil prices going down are probably good for the bulk of the population, even though they may not be so good for the bulk of the financiers in the shadow financial system. And cyclical companies have right now close to a 70% correlation, even though the vast majority of those cyclical companies with the price of oil don't have anything to do with the price of oil, but yet there's a huge correlation. And so I think that's sort of evidence from that. Mike Goldstein from Empirical just did some work on that just yesterday, and it's pretty interesting. And so here's another view, right? And think about this. Oh, commodity prices going down, they're deflationary, whatever. If you're the financier, what would you like someone to do? Well, you would like someone to help you out of your predicament, right? And so you're going to augur for easier monetary policy and fiscal stimulus because you're the financier. And so you want higher commodity prices. And so, of course, you think they're deflationary, right? And in fact, first order effects, and this is where it gets really tricky, first order effects of lower oil prices, lower commodity prices, but primarily oil prices, because it's so important, have been deflationary. But after a period of time, they've been strongly reflationary. And so, in my own view, we've discounted the former, discounted in market prices. We haven't discounted the latter. And if we discount the latter, everything changes. Rates change, currencies change. It's a much different situation. And this is where the real economy may take sort of revenge on the financial economy. This lower oil price is the first QE for the regular person. It's a big deal. And if you think about it from, there's different ways of thinking about it, but there's also, you have to consider even velocity. If you think about the money over the last 10 years, say 2004 to 2014, that went primary to Middle East and other sovereigns, a lot of that was saved. It's one of the reasons why the sovereign wealth funds got so big, because that money was saved. But that was financed, that money that went over went courtesy of higher rents that they charged everyone else via the oil price check. If that goes the other way, and so the velocity going from spending to savings isn't good. I mean, it's sort of the, you go to basically a zero velocity. When you come back the other way, however, the velocity increases. No one's talking about that. It's asymmetric. When the money comes from savings and it comes back into spending, now we don't have a global savings glut, which is what Greenspan famously called this idea. We have a global spending spree. So I don't think it's a coincidence that we're having the labor markets in the U.S., what's going on there, what we're seeing. I think a lot of it is coming through this lower oil price channel. And that's just to the point where interest rates are the lowest levels they've ever been in history. And again, courtesy of Charles Dumas, some of you may know at LSR, people take care of their economic pain faster than they do their gain. Real consumers say, well, I'm not sure lower oil prices are going to last. I'm going to save a little bit for a while, and then they spend. But people that have economic pain, lower oil prices, I'm a producer, I've got to cut my staff, I've got to cut CapEx, I've got to do different things. So that happens quickly. And again, this is the issue. You're pricing in one scenario as the real economy, potentially, the real economy, not the financial economy, moves to another scenario. So there's this contrast with the financial economy and the real economy. And again, that leads to, or could lead to, some pretty severe adjustment in financial market prices, probably especially in the rates markets. So these are all just points I thought were helpful, but for younger market participants, they've only known really commodity market leadership as their cycle. You know, everybody, there's this Wall Street, everybody gets a cycle. You know, I remember tech people in the 90s kept going back to tech in the early part of the aughts. Even though clearly there were things going in emerging markets and commodities, they didn't want to go there, they want to go back to tech. You know, you can go back to the one you brought, I guess. And so we've got that sort of behavioral dynamic from a lot of younger participants, and they just feel better when commodities go higher, and they feel worse when commodities go lower, because that's the leadership they knew. But when you imbue the whole financing framework from the shadow financial system and what that does, and then you put on the great trauma inflicted on all of financial market participants from certainly most of the recent financial crisis. I just think that we need to be thinking about this collectively from a policy-making standpoint and from a market participant standpoint, to realize that there are alternatives to the present narratives that we hear over and over and over, and that those alternatives, in large part, are not being discussed because the consensus narrative is being promoted by those with a strong interest in that narrative. So anyway, thank you very much.
Thank you, Mike, and thank you for the outstanding work you all do with our markets and have been for years. The last time two people named Masters and Johnson teamed together was in 1957 Princeton University in St. Louis. I thought that was quite an appropriate factoid for the Minsky Conference. Though I promise you, however much I like working with Mike and me, our topic will never be as sexy as the rest. I thought I'd talk a little bit along the lines of the same themes Mike talked about, but about this what Mike called tendency of dogmatic narratives in finance to take hold. And it really becomes almost like a tribal anthropological war where people are repeating things in the realm of abstraction. That when you peek under the hood and look at some of the institutional detail, you then begin to raise questions again. First of all, I'll go back to 2008 when the oil price was rising. My own specialties were more related to finance, but I did previously work for a petroleum economist named Morris Edelman. And I went to Norway and I said, we got $140 price of oil. What does it cost you guys to bring it out of the ground? And they said, very simply, $52. That's our price all over the world. I said, well, there's a huge opportunity here. And they said, yes, it'll take us a year or two to bring it out of the ground and bring that to hold. But in essence, the Norwegian pension funds were selling oil forward against what the country's natural resource was. Well, I started watching that, and at the time I was doing a lot of consulting with hedge funds, particularly Arminio Fraga's fund in Brazil. And you could see these arguments taking place as though the arbitrage between the real economy and the financial economy that Mike referred to isn't frictionless. And when we get in our abstract mindset, we think that arbitrage is instantaneous. And I remember Paul Krugman writing all about, well, where are the inventories? I don't see a bunch of tankers offshore in New York stockpiling. And so there was a lot of tension about what is going on here. Subsequently documented, but I remember it at the time, Wei Zhong from Princeton University's Bentheim Center, who I think is really one of the leading thinkers in this realm of financialization of commodities. He described to me how in the West, our story, our narrative was somewhat like what Mike was describing, that the macro system is driving it, and the key at the margin of the macro system is Chinese growth. At the time, Chinese commodity markets were quite segmented through capital controls from the West. And the curious thing that Wei Zhong points out is that our oil prices were going up in commodity markets while theirs weren't. So it's kind of an awkward dilemma. Obviously, capital controls could explain things, but how you segment the information where the place that's the source of the real shock is not exhibiting the price behavior that we're seeing in the West. And I think, Mike, your earlier work for the Homeland Security Committee and some of the papers at Better Markets, like David Frank and Wally Tuberville's study in 2012, do what you might call reach in to how changes in the financial structure, what you called index speculators, really did create what you might call bursts within the financial market. And very importantly, economics, and particularly financial economics, assumes either some kind of stochastic process with a stationary distribution or perfect foresight in a non-stochastic model. And everybody that practices finance knows that we're sailing in the fog, that what Mervyn King, the former Bank of England governor, just talked about as radical uncertainty is really the realm in which we're all playing, and that makes it the range of possibilities for drawing inferences from prices from different sources, or to put it another way, scrambling your signal-to-noise ratio so you really don't know what's going on, is quite present. And when you introduce leveraged finance and what Wei Zhong calls time-varying risk premium, in other words, you go into a financial crisis or fear of one, or you've lost money in cyclical equities, how people rebalance their portfolios. In the real money sector, we might call just a reallocation. You've lost some money and you rebalance your portfolio, can send financial shocks into the commodity markets or from the commodity markets into others. That creates changes in prices. People draw inferences. There can be feedbacks across those markets. And this is not what you might call a well-anchored process. The use of leverage finance just magnifies the power of these shocks, because if you've lost on 4-to-1 leverage, you've lost a lot more. Your subsequent deleveraging and rebalancing sends very, very powerful shocks across marketplaces or market segments or into different markets, all of which can be contained within your portfolio. This is analogous to what they had in the Asian and Russian crisis. They used to call the tequila effects, where problems in Mexico affected problems in Brazil, or in other words, people who lost money in Mexico had to rebalance their emerging market portfolio, and then other things were sold. And what we're tending to see now is when those other things are sold, the correlations start to rise. It may be transient. I remember when this commodity boom started, 2004 and 5, many people were saying to me, well, this will be a whole new asset class. I remember Jim Rogers writing about this will be a whole new asset class. Well, it's a really good thing to remember that prices that are based on subjective psychological expectations are not very structural. And the distribution that you derive from recent experience looks like a nice bell curve, usually with a little bit of fat tails, but that doesn't mean it's stationary. It probably is unmoored because those expectations can change, and with it, the correlations, and with it, the diversification that you thought you would achieve. It's good to monitor these things. It's just not good to go to sleep believing that you've achieved diversification for some kind of mysterious structural reason when we're out there in that unmoored ether of radical uncertainty. I think in my own work over this last couple, 3 years, I've been very interested in and involved in the modernization and the international integration of the Chinese financial system. And what I sense is very important about having a much more, what you might call, open and skeptical view of financial theory is that when the ambitious and the rent seekers and the technically capable show up in a place like China, where the per capita income in the country is still under $10,000 a year, and lots of people depend on energy and food, that if you set up commodity markets in China on the grounds that they're going to be, what you might call, a tool that is universally helpful, maybe you're selling snake oil. The way I put it, when I was in Shanghai, Shanghai is the place that wants to be the financial center. And I always tell guys in Shanghai, come to New York where I live, because nobody likes the financial center. But you guys think you're going to be really popular. But I always tell, well, what I did tell them last July, is we were talking about the modernization of their markets, the sequencing of that, and the subsequent international integration. And what I told them two kind of parables. I said, the first thing that amazes me about the study of financial markets and its relation to China is that I feel like I'm in the 4th chapter of a novel. And the novel is a romance novel. We'll say in this instance, the woman is China, and the man is the international capital market. Now, you're halfway through this novel, and you're thinking about the LDC debt crisis, the savings and loan crisis, the Mexican crisis, the Russian crisis, the Asian financial crisis, the dot-com bubble, the great financial crisis, and taper tantrums. And you say to yourself, why is this woman want to get married? And they all laughed, but they persist in their enthusiasm. And so they said to me, what should we do? In the Q&A of the same speech. And I said, all right, when I was young, I fancied being a naval architect. I wanted to design ships. And I know that most people, when they think about going sailing, envision that they will go sailing and it will be a sunset. They'll have their significant other on their arm. They'll be smiling, drinking a gin and tonic. I guarantee you, when I was interested in naval architecture as an undergraduate at MIT, I never thought about designing a boat for those conditions. I designed the boat for tsunamis and typhoons. And so what I felt that the Chinese needed to do was to be extremely sensitive to the plumbing of their own domestic financial system and develop the experience in regulation and supervision so that they could then bring that, what you might call, fortified ship into connection with the tsunamis and the typhoons of the international markets. And when this speech was published in a Chinese magazine, and subsequently when I've been back 2 or 3 times, the place where the Chinese officials seem most anxious is about the commodity markets. Because lots of people living close to subsistence are concerned about variations in food price or energy, particularly energy that relates to producing protein, and they're terrified of particularly bubbles driving up the cost. And as you probably know, Chinese officials are very, very anxious about social instability. So I think, and I mentioned Wei Zhong at Princeton, he's working with us very much now, and well, he's doing his own work. We're trying to help him, is what I should say, on how do these markets really operate, how these simplistic parables related to inventories or related to arbitrage do not hold empirically. And so we're still, how would I say, in the realm of a bit of mystery, but misspecification and assuming that we know a lot more than we do reminds me of what Mark Twain said. He said, it's not the things you don't know that get you in trouble. It's the things that you know for sure that just ain't so. Thanks.
Thank you very much. That very insightful opening remarks. But I wanted to take it back to that time in 2008. And given what we know now, we're here in the midst of a commodity price correction, which some people still are not sure whether we've reached the bottom of or not. Can we say that what we experienced in 2008 was a bubble? And if it was a bubble, to what degree, the contrary viewpoint might be that it was a justifiable bubble because it encouraged the investment we needed in alternative energy sources, shale, etc., and the sort of stuff that eventually liberated us from the Middle East oil situation. Today, for example, Saudi Arabia has been downgraded by Fitch. I mean, this is something that was just not envisioned back in 2008. So what's your perspective on that, Mike and Robert, respectively?
Well, I'll just say, in my view, I mean, the financial sector, when you get these booms and busts, it just seems like there has to be a better way than having a boom and bust all the time to have these longer term effects. And I do think you're going to get, and you have, and you will continue to have longer term effects that I think are very significant and probably very positive to society. To a certain extent, having that boom, if you will, was a bit of the old the movie Pay It Forward or whatever, where society has already taken the pain, and of course no one really can see that there's gain out there as well at the time. And I think even right now, I think people feel like that there's no gain in this whole process, but there's real and substantial gains, and those are going to probably change our world. So it's not all bad in the sense of having, this is what market prices are supposed to do. The problem is when you have all the leverage on it and you have all these new products and you financialize these markets, you get moves that are much higher and lower than they should be. And so you get a lot of misallocation of capital. You get more supply than you probably need because the price signal doesn't need to be that high to incent. In other words, once the price goes above 52, let's say $60 or $70, you've done it. You don't need to go to 140 to get more supply. And, you know, people say, oh, well, the cost goes to, you know, it was really 80 or 90 or whatever, but all those prices are inflated by the fact that all the suppliers say, oh, look, the price is 140, so I'm going to jack up my prices and whatnot. And by the way, on the way down, the same thing happens. I mean, when on the way down, what people forget, and you know, today, present day, people talk about, oh, we've reduced CapEx, we've done all this. There's a big difference in reducing CapEx costs and units, right? So you're still going from New York to Topeka, but your ticket just costs 50% less. You're still taking the train, and you're still going to get there. And so, anyway, but the genie that I think you're referring to, that you really can't put back in the bottle, and it's done, and it's out, is innovation. And that's like the party guest that won't leave your party. In fact, it's even worse than that. After the party's over, this guest not only stays, but this guest comes back and brings 3 of his friends. And so you have a real problem with innovation because it tends to accelerate as the prices go down, as necessity is the mother of invention. Sorry to use so many sort of cliches, but I really think that's what's going on. And so a lot of the things you've got going on, and Tesla is a great example, and a lot of these other things, these are existential threats to the oil markets, and we've never had these in the past. And so those kinds of things, and they're not going back in, and all the new technology and shale oil and all the things we're doing and all the innovation that was created, that's never going away. And it's only going to accelerate. Anybody that wants, so the next move up in price, you've got all the DUCs, the drilled uncompleted, all these different things that are happening. All these things are there, and they're going to continue, which what it means is it's likely to be a much lower price of oil and much lower price of commodities for much longer than anybody thinks.
I feel like I'm listening to what we might call the William Blake theory of modernization. William Blake is famous for the road of excess leads to the palace of wisdom. And so the question of excess in this instance is on the, I hear, like many of you know, Bill Janeway, who's part of our INET board, has talked about the importance of excess in transforming the structure of the economy over time. And he particularly talks about the dot-com era and some of the spin-offs there. But bubbles aren't universally helpful. I don't think the boom and bust in housing left us with a productivity residual that made it all worthwhile. So I'm a little bit cautious about how do you say, whatever the circumstance are in an episode, creating a universal narrative which suggests that this is the way it must be or a healthy thing to see unfold. Having said that, I think what we're dealing with right now was that overinvestment and supply, which there is now, as you mentioned, innovative change that's non-transient. There is some drilling and equipment and so forth that will depreciate over time, and we'd be back at square one. So we got a long tail on the excess, but it's not a permanent change. But I think overall, there's an awful lot going on, whether with solar or wind and other dimensions, are now moving into the realm of commercial viability. And my biggest concern with this glut is that it actually creates disincentives for something that environmentalists tell me should be taking place at an even faster pace than it is right now.
So given that there is perhaps some justification for a bubble that creates positive after effects such as renewables, etc., etc., would you say that it was the best way to fund that sort of capex expenditure through the speculative arm of the market, or what would have been the alternative? And I'm playing devil's advocate.
I think there has to be a better way. I think, having more, from my point of view, having a more of a regulated financial system that doesn't allow some of these sort of, financial innovation. It's like all innovation. It doesn't mean it's all good. It's trial and error. And so, from my point of view, there's had we not had the advent of commodity index funds and the wholesale adoption of commodities as an asset class, which I don't think they're an asset class to this day. I think that the whole concept is just ridiculous. This is the fruits of production, not the means of production. I won't get into all that, but it's a much different situation. But without that, I think prices probably would have gone up. And I think you still would have had enough price formation to incent a lot of these behaviors that you had. And I think you would have done that in a better way for society. You could argue that the final push off the cliff for the American consumer and what helped precipitate the rapid change in certainly in Wall Street collateral, but also in terms of the housing crisis. That final push down the stairs was the $140 move in oil prices, and so you could make a good argument that helped collapse the economy in some ways. And indeed, every other time oil prices have gone up very significantly, they've always precipitated recessions. And so, from my own point of view, I think without all this financial innovation, I think we're probably better off, and we could have had a move up in price, but not everything has to be a bubble. We don't have to have a bubble all the time in finance, and I think if finance is working properly, we shouldn't have the bubbles that we're having. I don't think we should have them. I think they're a real problem. So,
Robert, any perspective on whether or not we could have found an alternative? An alternative category of investors to fund this transition?
As I was listening to you, I remembered one summer in about 2009 it was, that I had lunch with Felix Roth. And you may all remember his book, Bold Endeavors, about large infrastructure projects. And he was arguing for a sort of public sector capital budget and banking. And the hard part was we were coming out of the housing crisis, and Fannie and Freddie were not too popular in the narrative. But I could imagine an infrastructure bank that would play a constructive role in these kinds of areas. I don't necessarily think that state lending has an edge in rationality. I'm not sure at times it is at a disadvantage either. But in a different time, perhaps a mechanism that involved energy transformation in light of the daunting challenges of the environment and excess carbon burning would warrant a public initiative. And I just think that, as I said, when I talked to Robert, politics just weren't right for trying to inspire us as a nation to change in that direction.
So is the issue then that you feel, perhaps, Michael, that speculators were a little bit misled through the mechanisms that banks use to encourage this sort of mythos of a diversified asset class for them? Is that part of the issue? That they didn't necessarily know what they were getting into, that it was a cyclical investment?
I think they were absolutely misled. I don't think they were misled necessarily by the investment banks as much as they were sort of misled by sort of modern portfolio theory. That to me is, the whole, if you go to these meetings with these large institutional investors and you listen to consultants talk about the efficient frontier and all this other sort of stuff, a lot of it's just, BS in the real world. So, I think that I think clearly they were misled. And if you wanted to invest in the commodity boom, invest in the means of production. And there was plenty of ways of doing that. So if you invest in the equities, for instance, there's one commission, and this is where the intermediaries actually had some responsibility. If you invest in a commodity index, there's 24 commodities, so there's 24 commissions, and then they expire every quarter. So there's 24 chances for rolls by your friends on the swaps desk, and 4 times a year. So you can do the math. It's a lot more than one commission you get when you buy the equity and you sit with it. So clearly, in my view, they should have done the former, not the latter, but they did the latter. So
my tendency would be to say that we're in a place where most of what was misleading was that people felt good when prices going up after they bought a new instrument, and they stayed with it too long. They did buy narratives or other stories that validated their good feelings. I was talking to Mike earlier that I often get the impression in financial markets that people are looking through binoculars backwards. They're drawing inferences that make them feel good. They're not magnifying in the discovery mode. And my sense, secondly, and I think this is troubling in almost every major sector, is that the power of concentrated interests in the politics of the United States is defeating the common good with regard to energy, financial system architecture, healthcare, and everything else. In that, what you might call the 96 rolls per year were the product of an industry which is very good at marketing and can control in the legislature the structure of those marketplaces. Where I was much more concerned in 2008, I wasn't as tuned into this dimension as Mike was, with regard to over-the-counter derivatives and what we call playfully gospel pricing. And the idea that you were going to put derivatives onto exchanges where prices became transparent and reliable was, in my mind, a very long shot after I read Brad Hint's report, where he estimated that moving everything to an exchange would reduce the profitability of the derivatives industry of essentially the top 6 institutions by 20%. That 20% was $7 billion. And at that time, the money for lobbying and campaign contributions that had been put forward by that small group of banks was in the neighborhood of $600 million. And I thought, well, if you have a bill every 4 or 5 years, these guys are stopping things with $600 million to make an incremental $35 million. And that's a risk reward, unless you remove that form of influence from the process, you're never going to get healthy rules. And I think that calculus was extreme, but I think this kind of obstacle to proper structural reform is pervasive in America right now. It's part of why we have some very scary people in the public voting elections.
We'll take some questions, and then I'll interject as well. So, right at the back there, there's a very keen question and metaphor, I think.
Please wait for a mic.
Oh yes, please wait
sorry.
for the microphone.
Just to thank you both for your presentations, which were really good. Michael, I want to say to you that I take your point entirely about the financialization of the commodities markets and the impact on prices. But you need to also surely accept that there is weakening of demand in the global economy, particularly in Europe, where austerity policies have really aimed at weakening demand in a sense. And of course, as a result of gluts that have built up in China and so on. So while I buy your thesis, I also wonder, are you denying the weakness of demand that there is? I'm asking.
thanks. No, I'm not denying that, and there's clearly fundamental weaknesses around the world, in some cases because of, for instance, the emerging markets, many of them are sort of commodity-centric, and so, having lower commodities isn't good for them, but, ceteris paribus. But what I guess I'm trying to say is that I also think having sort of a bubble of negativity, if you will, that's coming primarily from financial market participants, even if there is some fact to it around the world, and there definitely is, going to the point about narratives, I think is dangerous as well, because I think we need to inoculate ourselves from some of these narratives so that we understand that there are two sides to every story. And the other side, I don't hear very much about. And it's a bit, I don't know if any of you saw the movie with the British, the British, God bless them, they fought everybody. And they fought the Zulus. And there was just millions and millions of Zulus coming, I forget the name of the movie, but they were throwing spears. Yeah, Michael Caine, yeah. And anyway, but I always think about that. I mean, there's a lot more of them than there are financial market participants. And I think certainly in some of the developed market economies and in places like China, having lower commodity prices is a huge benefit to people, and it's also a huge benefit from the standpoint of moving money out of savings and back into spending around the world. And I think that we all know that weakening narrative, and it's absolutely, there's some truth in it without question. But I guess my point was, let's think about the other side.
Just to add to Anne's question, though, if one of the mysteries at the moment is why there hasn't been this energy boon from the fact that oil prices have gone down, and why somebody's got directions. Is that me?
It's a cheap, somebody with directions.
Okay. So I was just going to add, why do you think we haven't had that sort of boon from lower energy prices, and is that because on the way down there are financialized effects, so that we've seen the shale producers going bust, we've seen, well, not all of them, but there has been unexpected sort of financialization complications on the way down as well. Is that fair?
Well, I would say that we probably have seen some of those benefits.
Can you use the mic, please?
Oh, sure. On net, things may still be decelerating and going down, but some of those supportive elements, like you might call the wealth effect of lower oil prices, it's like a tax cut, may be, in a counterfactual sense, if you didn't have that, we'd be going down faster. Obviously, as you said, in commodities, it's a kind of zero-sum dimension. The producers losing wealth are the other side of the consumers gaining wealth. Mm-hmm. And so it may not be as large a net effect in the short run. The other thing that I think is very important here is, when Ann, you asked the question, we don't have to deny that the world is slowing down now, and that can be correlated with a decline in energy prices. In order to say, in 2008, when emerging markets were decelerating, oil prices boomed without the real economy impetus, even though people use that narrative. So there's, as I mentioned in my talk, there's this signal processing problem where they may be going up or down. It may be influenced by the real economy, or it may be other things. And just maintaining a skeptic's attitude, I think, is important.
Yeah. Also, I think, this first order effects and second order effects. I mean, if you think about the slowdown in CapEx and that drop, that's largely happened. CapEx in dollars dropped 75%. It's the next drop isn't going to be as bad. So from a comparison standpoint, each quarter you cycle through this, you're getting less bad, which is the same as good as far as I'm concerned. And moreover, the consumer, assuming oil prices sort of stay in this range, is, if they wanted to save or they wanted to see if things were okay, each quarter they see that they're more okay than they were before. And so you get this, in my view, you would get this culmination. It's not to say that, to Rob's point, that the counterfactual argument, and I think there's a lot of truth to that. I think that maybe things would have been worse without it, just as I think things would have been worse probably in '09 without the drop in oil, which probably helped the consumer out there. But if this is going to be longer lasting, I think the surprise to financial market participants anyway may be the resilience of the consumer and the resilience of labor, and that things are less bad going forward than is embedded in current market expectations. And if that happens, then there's a big impact on the rates markets and other markets.
I think we should nominate Mike to write the Democratic Party platform, because less bad is now just the same as good.
A question right up here at the front.
Thanks. This is a great discussion. So, Mike, you said the genie is out of the bottle, by which I took it to mean the financialization now of these commodity markets. And Rob's clear, bleak but clear analysis of the power of money in politics notwithstanding, I guess I'd say if you could wave a wand and say what specifically would be the main targets of a regulatory regime that attempted to deal with this problem, the problems you're describing. And I guess, Rob, for you, a little more expansion on, you are talking with the Chinese, but as they think about how do they want to engage with international commodities markets and the relation to their own domestic economy and domestic finance, what are the mistakes they should avoid absolutely, what to look out for? So what, if you could do something, what are the key targets to do, and then what should a place like China avoid to get further sucked down into this?
So first, just to be clear, I was talking about I guess there's two genies, right? Okay. So there was the genie I was actually referring to as sort of the genie of innovation,
Not financial.
Not financial, real, true innovation, real changes in technology that lead to, more energy, either supply or demand. But the genie of financialization was let out a long time ago, and that probably, started with the change of the prudent investor rule with pension funds, and goes on to the Commodity Futures Modernization Act, and each time the genie not only came out but became a stronger and stronger genie, right, until we had the financial crisis. And so what we advocated back then, and what we still advocate, is this idea of, first of all, getting swaps on exchanges, getting rid of the swaps loophole, which is basically a way out of position limits in commodities that have been traditionally used to control excessive speculation, not just manipulation, but excessive speculation, making the commodity markets, making the primacy of price formation for hedgers, and having speculators there to serve the needs, which they traditionally were about 20% of the open interest. Today they're about 70, right? So it'd be great to have them back below, certainly below 50, so that hedgers would have at least sort of an equal footing in terms of just from an open interest standpoint. So that was my view on open interest, is you get the market that you get, and you can have a market. It doesn't have to be a market that's the way it's structured now. It could be a market that has limits on speculation, and the devil really is in the details there, right? But which certainly theoretically would you'd have a market more like you had in the past with less kinds of disturbances.
I think Mike's sense of what you might call proportion in the open interest of different classes of participants is a very important thing, both to be able to monitor and to limit. With regard to China, I use the analogy of the credit default swaps. You kind of need an insurable risk in order to have insurance. There are all kinds of games that go on when you don't put those constraints on. For instance, in the old maritime world of Great Britain, you could buy insurance on another ship and then go tell your French colleagues to sink that ship so you could collect, even if you didn't own the ship. And they quickly learned about those shenanigans and brought it to heel. In China right now, I believe on the basic commodities, particularly related to food, they need to really limit leverage and really limit the composition of who can play more than anything else. And I do not think they should internationally integrate so that arbitrageurs between Shanghai and offshore can, what you might call, go surfing with the world economy. I think they need to create something that has to do with their own real needs.
Going back to sort of what pricked the bubble more recently, to what degree do you think the recent legislation or talk of legislation with respect to the banks and commodities, did that play a role, do you think? The Federal Reserve coming out with a proposal on how it would force higher capital rules on banks who are trading commodities. Do you think they then pulled out to some degree and this helped to unfinancialize the market, or was that just a coincidence? We saw JP Morgan obviously selling off its commodity division, etc.
I think that the idea that you're sort of espousing, I think it sort of goes to the story about not being thrown in the briar patch. I think that many banks, certainly many people I talked to at the banks on trading desks, were well aware of what was going on in terms of the amount of supply that was happening, and I think they were happy to be out of the commodity business, and they were happy to have an excuse to sell their commodity business to some unsuspecting other intermediary, whether that be Glencore or someone like that, Vitol or something like that. But I don't think it necessarily had a role in pricking the bubble, if you will. I think that was, eventually we were going to have enough supply where we were going to drown it, and I think that was at some point evident even to the Saudis, who I think let it go on for probably longer than they should have. So, I mean, I just don't think that was the case. People talk about banks, about the liquidity, and they say, well, I can't move these kinds of products now, and the banks aren't willing to buy them because of Volcker. Again, I think it's a sort of a briar patch kind of a situation. I think banks are happy in a declining asset environment not to buy those assets.
Because one might argue that one of the unintended consequences of the banks moving out of commodities has been the lack of financing availability for the intermediaries, the sort of hedging into trading companies such as Vitol, Glencore, Mercuria. And we've seen, obviously, a lot of these companies having to go to the equity markets to bolster up their balance sheets because they don't have that cheap financing available to them anymore. Is any comments on what's been going on? I mean, to what degree were these intermediaries just pass-through agents for the banks in terms of offering financing to, say, less credit-worthy consumers in the wider global financial system?
I think Mike's point about the briar patch is really related to the quality of price action. In an up market, lots of people want to buy, there's lots of liquidity. In a down market, in sailing they have something called wind against tide. When you're sailing and the tide's behind you and the wind's behind you, it's very smooth. When the tide is against the wind, the period of the waves is short and very steep, and you get thrashed about. And in bear markets, in almost anything, you have discontinuous, choppy, very volatile, illiquid things. Being a market maker is much more costly because of the nature of the price action. Then when you add regulatory and capital charges and the fact that you don't have a group of consumers, of investors inspired to give you deal flow, you just want to vacate the premises. I don't think that it's the same, how would I say, for each market segment as it is for the people who are like Evercore and others, the big funders or the big players in the area. That's a different segment of finance, though you may still think the future bodes ill for them because their playing field is that choppy wind against tide environment and would naturally pull back. I notice what I'll call almost momentum trading by all the too-big-to-fail banks. They go out and they buy all kinds of hedge funds in places like Brazil and invest in private equity, and they do all that stuff, and then the minute it turns down, they exit. And I think that has more to do with price dynamics than regulatory constraints. And tightening regulatory constraints makes everything more expensive and makes you trim your portfolio.
Okay, because in the Senate report there was a very specific reference saying that there was a perception that banks had an unfair advantage when they were competing with, say, more traditional operators because they had obviously cheaper, they had access to cheap financing. So did that skew the market in a different way when you had to, now that the banks are out, we'll see a more sort of balanced approach to the market?
I mean, I think that's a whole other risk. I mean, back then, I mean, so to Rob's point, people have been getting out, and so it's a sort of a different environment today. When you had that prior sort of boom, if you will, that market environment, things were, banks wanted to be there, and because of their low cost of capital, in part because of the boom, you could compete, sort of in my views, unfairly with the real economy. And this goes back to my comments on the real economy versus the financial economy. There's a perfect example. But I think the Fed mentioned this in one of their reports on this. Well, what happens if you're, Morgan Stanley, and let's go back to pre-2008, pre-Dodd-Frank, when the interconnection of derivatives was much more opaque, and there was a lot of OTC, there was a web there. What would have happened had they owned a big oil tanker and it ran aground in the tip of Manhattan? What happens to the global financial system? Well, first of all, what happens to Morgan Stanley? I mean, could that physical act actually create a panic in the global financial system that is literally a real economy, a real thing happening that actually affects, so that to me is, I think there's good reason to bring them out for things like that, which, what do you do if you're the Fed there? I mean, so, and the only reason I think they were in to begin with was because of sort of an oversight, or maybe it was an intentional oversight by the Fed to sort of allow them to go in there on this basis of, well, they needed that to sort of hedge their derivatives commodity exposure to begin with. So.
Question up front, yeah.
My recollection is that the first commodity index funds were proposed by, if I remember right, Bob Greer in the 1970s. And basically he did he put together the index, he did the correlation, and then they just sort of disappeared. And as you mentioned, really, somehow or other, this asset class was out there, and nobody paid any attention to it until we got to 2002, 2003, sort of post-dot-com. And then, and this is the link that I would like to make with your, the producer side and the consumer side. In fact, they were sold as real rate of return funds initially, because the idea was, what are we doing? Well, I'm hedging you against inflation. So it's that, it was sold as a consumer defense product. And what I would, sort of would like some comments on is first of all, was this at all possible? Because if you look at, you mentioned the role, and you look at the carry on the role in a contango market, basically that insurance, that real return insurance, starts getting very, very costly unless you can keep prices going up. So more or less what you had created was a system which, for the consumers, generated the need to insure yourself against the increase in prices that the insurance that you were buying was causing. So that this is, this is sort of a strange interaction between this, the producer and the consumer side. But in fact, as I remember when these things were done, that's how they were sold. They said, you buy this and you have perfect protection against inflation.
Yeah, I agree. And then it was popularized by Gary Gorton in this famous paper called Facts and Fallacies About Commodities. And it just goes to show you, when you don't have pre-financialization, you had an environment of mostly, it was the term is normal backwardation, because that's what typically was. And then as the as it was financialized, you had a state of contango, almost permanent contango, and we looked at this a lot, and that was a big change for the market structure, and is one of the reasons why banks needed to have physical commodities, because they could do the cash and carry. And it was one of the reasons why we disagreed with Professor Krugman at the time in 2008, because once you do it via swaps, there's no reason that you couldn't have that inventory on the ground and just do a swap via someone, and with some oil producer in the Middle East or wherever, and say, hey, and then do a basis swap versus TI, and then you're really in business. And so all you really did is you made the U.S. and world pension fund industry pay for the cost of commodity storage, which is crazy, but that's what you did. So anyway.
You mentioned also correlations, and Mike, you referred to the effect of the consequences of financialization on correlations everywhere. Tell us a little bit more about why that's important, and what are the side effects if and when those correlations suddenly become discorrelations.
As things get correlated, it's harder and harder really to if you go back to this whole modern portfolio theory and uncorrelated assets and the efficient frontier. Once everybody does something, everything becomes more correlated, because it's really the same as something else. It's just a different name. So we're all trading the same things. They're all on our Bloomberg screen, and they all, we sell everything or buy everything at the same time, and that's really a problem. And this goes to passive indexing, in general. Capitalism is supposed to price risk versus return, and there should be a cost on different risk. And when you do these, you have this high correlation environment, of course it's hard on active management, because everything's much more correlated. But that, the world of finance is making everything more correlated. So I think it's a big issue, and but I also think that it's really important for financial participants and policymakers to understand that those correlations may not be justified in the real economy, and probably in many cases are not. And even if market prices in that sense, going to my earlier point, are not as predictive about the fundamentals of the economy, precisely because of this correlation.
Yeah, and is it dangerous when we see sort of trading institutions hedging real economy commodities with financial, completely unconnected asset classes? I've heard of people hedging gasoline with Turkish lira, for example. Is that based on the historic correlations and the assumption that will go forwards?
When I worked for George Soros, and any of our partners got into this kind of monkey business, his little adage was, the hedge becomes a wedge. Just sell it. Don't try to hedge. Because often what would happen is a trader is fearing illiquidity on exit, so he finds something else he can buy as the offset. But I did note in preparation for this that the commodity baskets between 1998 and 2004 had a bandwidth of correlations between -0.2 and 0.2. By 2008, commodities were at +0.7, both vis-a-vis equities and vis-a-vis oil. So you had, in Jan's question, you had a situation where the story of diversification was sold and digested, but the actuality morphed, and that hedge became a wedge. And I think that's quite pervasive.
Any more questions? Up front again.
Hi. So it's interesting we came to commodity index bonds because in hindsight it's much easier to understand how the market prices got distorted. But we, as market participants, we know the price is not our only expectation of the very short term. In the long term, there's lots of risk issues involved. So how about a very simple narrative? So the real error, it seems like, Mike, and you pointed this out, was that somehow commodities are assets, right? That's really where it all starts. And the fact is they're not. right? Just like currency is not an asset. It's a tradable quantity, but it's not an asset. Once you buy the currency, you have to invest that money somewhere else, right? So it starts off with a very simple mistake. Currencies are assets, let's diversify. You know, Goldman Sachs says, I'll give you a currency swap. You know, it actually, I'm not sure that the narrative was as, you know, with the roles and you know, you could argue that that was what prompted them to do it, but that was a design that could. So at some point, though, the only reason they stopped doing it, and I presume there isn't that much, because as Jan pointed out, you went from backwardation to contango and it became too expensive to do it, right? So the thing is, can you regulate looking forward, or must you always do it in hindsight? Because what could you have done to stop that? Somebody had a good idea, it looked good on paper. You know, you can say there were bad agents in there, but really what you're doing is you're looking, you can look back and say, yeah, commodities are not an asset, and it should not be, it should be regulated as such. But can you do that looking forward? In this particular case, as you point out, you've got financial firms invested in fracking who want to hedge. I guess at some point they short oil, is that what it is? Okay. How do you stop that? You know, with foresight rather than hindsight.
There's a lot. There's a lot there. Yeah, I don't know. I think that there's, I would just maybe you go higher level. I mean, in terms of, you know, just going back to, not to pick on, you know, modern finance and how it's considered, but I mean, I just think there's some common sense stuff. I mean, typically, you know, if you and by the way, when I say this, this is always controversial. It seems like to someone, and I don't really think it should be controversial, but I mean, again, going back to the means of production versus the fruits of production, if you think about capital assets, they should produce cash flows, whether that's in rents or that's in dividends or that's in interest payments or, you know, some of those things. And in my view, that's what capital markets investors should be investing in, is assets that either have cash flows or have the potential. Obviously, some companies don't have cash flows, but the idea is they will have cash flows in the future. Commodities don't have cash flows. Currencies don't have cash flows. They simply are, you know, volatility trading. There's no cash flows in well, there can't be, but I mean, but still, I mean, it's these kind of more esoteric things to me. I don't think they're really appropriate for most capital markets investors, precisely because they don't have cash flows, because you're really speculating in them. They're just a tool of speculation. And in my view, large institutional investors should be engaged in the business of long-term capital investment and not engaged in the business of speculation.
I'll just add, the phrase that came into my imagination as I listened to you was Food and Drug Administration. Have laboratories. Financial innovations are tried out on small scale. It doesn't ensure, by the way, that the correlations won't change when it goes to larger scale, but some sense in which these things are not out there running wild and then we find out they were wrong and there's a great deal of harm done potentially. But we run laboratories, and when they look like they've passed some tests. Now, the political economy of the FDA isn't something I want to endorse, but I still have my money in politics problem right there in the front of my mind. But the notion of testing and permissions as distinct from let it rip and close it down if it causes a disaster is a different way of approaching the challenge.
I would just say one more thing. I mean, because this is a Masters and Johnson panel, that what Rob is really espousing, which we agree with, is the idea of prophylactic regulation.
Any more questions from the audience over there with the white paper?
Sort of follows up on that general discussion. There are two key words that no one has said explicitly: margin, position limit. And in agricultural commodities especially, where are they? That's one of the things that disappeared around 05, 06, and caused extreme volatility that Rob has already pointed out in agriculture, and maybe Goldman Sachs can stand 50% price volatility twice a year for corn, but the average corn farmer cannot do that. And so where are we with any prospect for return of effective margin or effective position limits in agriculture, especially in Washington today?
I'll go quickly. It depends on the composition of the Supreme Court. Because they're going to make the rules about what the rules can be about money and politics, and that will affect what rules we can make vis-a-vis any particular segment.
Michael, any opinion on the position limits where the regulation stands?
Yeah, I mean, I just think, I think what I've heard so far is what's been promulgated isn't going to be too strong. I mean, but the idea is right. The problem with the position limits, you have to do it all. It's sort of like a hydra. I mean, you can't just cut off some of the heads. You have to kill all, cut them all off. And so to have effective position limits, you have to have effective swaps regulation. Because via the swaps loophole, people that had position limits can just trade over the counter where there's no position limits and use the hedge exemption, which Goldman and other banks have, and use their exemption, and so therefore suddenly position limits become meaningless. And that's indeed why position limits have been widened by exchanges, because they had to compete with this swaps loophole. And so you have to do it all, and you have to deal with margin again, so that the over-the-counter markets look much more like a mirror of the listed markets, because after all, they're the component parts anyway. So that's the idea. And I'd like to get that. I think we're a ways away on the position limit side.
Is there a risk, though, if you over-regulate, and again, I'm playing devil's advocate here, that these markets will move to different jurisdictions? I mean, that's what we hear all the time from the opposing viewpoint, right? That you're just going to lose revenue from the financial market.
And the city of London is famous for that.
My fault.
So, so in the city of New York too, for that matter. But they all say that. I say, oh, okay. Well, if you do this, we're going to go to Singapore or wherever. I think today, and I wouldn't have said this 10 years ago, but I think today, if you're a large fiduciary, you want more transparency. Just from people are looking for more transparency. Large fiduciaries, just because something costs less doesn't mean they're going to go to that venue. And I think that threat, and we've heard that threat over and over and over, but it seems, in our view, it's sort of an empty threat. Because if you're, Wellington Management, and you want to do a swap, it's unlikely that you're going to go way out of your jurisdiction. I mean, it's certainly possible, but I think it's unlikely. So, I think it's an empty threat.
I would say it's a two-way street. That sometimes in the presence of the whiff of default risk, market structures that have more integrity and more transparency but are somewhat more costly may keep the business there rather than a flight out of anxiety about what's behind the hidden curtains. In other cases, the arbitrage between two relatively good places, say New York and London, people will take advantage of the lower cost environment, provided the integrity is already assured.
So is that an argument against the market moving to less to jurisdictions that don't necessarily have the same track record in terms of guaranteeing the contract?
It may be track record, or it may be things like, for instance, in 2008, the Swiss banks got in trouble because the size of the Swiss tax base was not able to bail out two banks that had assets of 880% of GDP. So the notion of too big to fail was, how do they say, not on the cards. The United States, the EU, and others become platforms where those guarantees, how do they say, are credible and allow the commerce to be safer in that context.
And
perhaps to the detriment of the, what you might call contingent liability of the body politic, but as long as it's in place, it's still a safe market.
And in that context, what would you say about China's role in that environment, given that so much commodity trade is now flocking towards, say, Hong Kong? And we're seeing also a lot of collateralization, and we've seen a lot of scandals over there with respect to the real commodity stuff.
My view right now, I was over there in January and they were very concerned about the RMB. My view right now is that the quality of the capital markets, the reporting on companies, understanding limits of state-owned enterprise finance, even what people euphemistically just call in the large the rule of law, will cripple the attraction of the RMB. For instance, the case that I worked on when I was over there this last time was you have all these municipalities with enterprises losing money and their banks being asked by the state to extend loans.
Mm-hmm.
So there's a contingent liability hanging out there that will probably be federalized at some point. Then you try to set up a sovereign bond market for the federal government. And people then say, okay, you know, a lot of Western places you can see the debt to GDP ratio. Are these people at risk of having a default or rescheduling or not? And the question is, how big is that contingent liability? When you're in that muddiness, you're not going to sell an RMB sovereign bond market as a benchmark for big portfolios around the world until they clean up that the nature of what could be federalized. If everybody goes in and incorporates into their portfolio whatever their standard weighting for all, say, the currencies in the SDR, and then you find out, oh no, it wasn't 106% of GDP, it's 205.
Mm-hmm.
Then all kinds of people are holding bad bonds. But they have good bonds. Right now, things are not clean enough in China to be inspiring to the international capital market. Specific business deals are. Foreign direct investment has been largely a deal. But portfolio stuff is still a little bit anxious.
I think we've got about 10 minutes left, is that right? Unless you're all bored, in which case we can wind up now. But perhaps any more questions? Right at the back, I think.
I want to be a bad boy, get away from regulation, and talk about will the global economic environment constrain U.S. growth and employment commodities. 8 years ago at this time, I gave a blood-curdling, bearish prognostication about commodities. Anyone who was here in 2008 might remember. All the speculation and all the manipulation has been wiped out of this market. So now we all feel very comfortable with low oil prices. If you look at the existing data on oil inventories, Jody, IEA, what have you, what you find out is that the big fat surplus that everyone thinks exists does not show up in the visible inventories. In 1998, the data was all wrong. We went to $10 oil. 18 months later, we were at $37 oil. We've never had these decline rates. We have a 40% decline in investment, in exploration and production. We have never had it. And there is no spare capacity in the world. If this hypothesis based on the inventory data, the decline rates, and the collapse in investment is correct, there's going to be one huge spike in the price of oil. And it's going to change the whole way we assess the global economic environment and its impact on U.S. growth and employment. So everyone, it seems to me, here is comfortable. It's all over. The oil price is low. I was an old bear. I give you this hypothesis. I'm not sure it's right. It's based on the data, but it could be the big shock of the second half of this year.
That's the second
I see
order
Putin
effect,
grinning.
right? But that's a point referring to your second order effects, right, of what we've seen. Is this just a temporary lull? Are we gonna see a big spike? Or is there an argument to be made that shale is a manufacturing process, and that's the difference here?
I mean, I would say that I absolutely think shale is a manufacturing process, and I think the innovation there is substantial and will continue, and there are lots of things like DUCs that can come online very quickly. That being said, to your point, there is an issue, in my view, with the offshore, where exploration has come down significantly, and where and people aren't talking about that, and that's to me is an issue because the price goes up. I was at a conference in January, and the president of EOG said, which is probably the leader, for those of you who don't know, in the shale, in the Permian certainly, and the Bakken and the Eagle Ford, talked about that 50 is the new 100. That we make more, he literally said this, we make more at $50 a barrel than we did at 100 2 years ago because of the cost reductions and so forth. So I'm not as worried about the ability for the U.S. guys to come on stream pretty quickly, assuming the present, ceteris paribus, the present financing environment stays in place and so forth. But I am worried about the offshore issue, and also, if global demand continues and it's higher than people think, and I actually think that's a pretty good bet, then you could get some more demand effects that could bring a higher price as well. I think it's more likely than not that we do have a positive surprise in growth, especially considering the consensus view today, which is predominantly negative.
Mike, the problem is shale's 5% of production. We've got 95% of the production that is old reservoirs with higher decline rates than we have ever had, and a 40% decline in investment globally.
That's what I was going to ask you, Frank. With this, what you might call social needs in an unstable Middle East and in Russia, are there wells? Is there elasticity in supply there?
Gawar is the great oil field of the world. It has been most of Saudi production. Very few people realize that Aramco said 3 years ago when they brought on Kurais and Manifa, 2.2 million additional barrels per day, that they would have a 12.5 million barrel a day capacity, and they now say they only have an 11 million barrel a day capacity because Gawar has been taken back by 400,000 barrels a day on the last assessment, and all of their older fields are in this condition. But it's everywhere, not just in OPEC. And no one is paying any attention. When we were at $100 oil, it was fashionable to talk about decline rates at peak oil. Now we're down here and everyone says, oh, we can produce oil in the Bakken for $50. It's 5 million barrels a day. And if you look at the monthly data on the decline rates in shale, we have the data. It looks horrific this year. Big decline rates.
But also to that point, what about the argument that we have also reached peak demand? So perhaps the decline rates can be offset by changing demand consumption styles.
I'm sympathetic to the point, to Frank's point. I just think that we shouldn't underestimate technology in general. And I'm not saying that's the end-all be-all necessarily, but in this case, I think it's very significant. There's no reason why, for instance, the U.S. has the only good rocks for shale exploration. Certainly in South America, they've got good rocks. There are people down there. All of this takes time. It's a long process. The whole idea of the electrification of the auto fleet, that takes a long time. So in the short term, you could have spikes in oil, and we're certainly not arguing against that, especially if you have better than expected economic demand, again, which I think is quite a possibility. But the long-term trend, in my view, especially if we get a spike in oil, is continued technological change. And I think it'll be more rapid than anybody thinks. And I think it's one of the reasons why the Saudis are saying, hey, we need this $2 trillion wealth fund, and we want to, we want to go into solar energy and all these crazy things you would have never heard them say in the past. They're talking about. And if you think about it from their point of view, and you look at it from a DCF standpoint, if you assume the price is flat or up, you get one calculation. But if you assume the price is down, I'm talking 10 years from now, you're much better off producing all you can right now and just putting it out. So, we'll see.
And just wondering, how does that fit in with the stranded assets argument that we're actually, I don't know how familiar you are with it, presumably very, that that essentially if this is a peak demand scenario, a lot of these carbon resources can't be burned. So actually declining rates are kind of an irrelevance at this point, although we obviously have to manage the balance, right?
I guess it's the tension between driving and breathing. Those are coming from different places, and one would expect the social unsustainability as fear of environmental deterioration to, how I say, markedly change the politics of production and conservation. When you brought up in the question that Mike started with here, conservation usually responds to the price incentives rather than preempts them. But we may have a different impetus now because we're concerned about climate change. And it's another thing the Chinese are talking about is the transformation of their economy as a Green New Deal. And clearly in the solar realm, they have made massive investments and brought down the cost of solar markedly, much to the chagrin of many people in Northern California.
So I think we're nearly at the end, unless anyone, we are at the end. Okay.